The government's jobs report for February came in much stronger than expected today, and stocks sold off in response. Why do signals of a stronger economy bother the stock market, you might be wondering? We'll get to that in today's video. We're going to look at what the government released in their latest report, what's driving the numbers, and why this matters to you. Let's get into it. Non-farm employment surged by 678,000 payroll positions in February, the largest monthly gain since last July, and an acceleration over January's 481,000 gain. U.S. payroll employment is now 2.1 million jobs below where we were in February of 2020, just before we essentially shut down our economy due to the pandemic. Notably, not a single major sector of the economy posted negative growth last month, with the biggest gains coming from the leisure and hospitality sector, but also from the educational and healthcare sector and professional and business sector. This was largely a result of further reopenings after the Omicron variant retreated from its surge in January. The leisure and hospitality sector, primarily restaurants and hotels, made up more than a quarter of all gains in February. This sector has been hit hard over the course of the pandemic, and while it has staged a strong recovery, it is still 1.5 million jobs below where it was in February 2020. So we know what's driving the numbers, and it basically shows the economy is getting stronger. But why does that matter to you? And why is the stock market selling off because of it? Now, first, we do have to acknowledge that stocks have been selling off recently because of the war in Ukraine this last week, which has the potential to hit our economy pretty hard. Check out our recent video we did before the war started to highlight how it could hurt our economy. But also, it's because of the Federal Reserve and its upcoming meeting to decide their path on monetary policy. The Fed has a bit of a balancing act right now with inflation at its highest level in 40 years, and they have to raise interest rates and shut down the money printing to rein it in without crashing the economy as a result. So this strong jobs report is going to leave them feeling a bit better about pursuing a tighter monetary policy because the economy is strengthening and might be able to withstand it better. The stock market is selling off because it's basically throwing a tantrum at the age of easy money winding down, but also because rising interest rates could lead to a pullback in economic activity, which would affect company performance and put downward pressure on stock prices. It also spells big trouble for the housing market as mortgage rates rise along with other rates and sap demand for homes that are already priced at record high levels. These are the dynamics we're working with right now. If you want a deeper dive on how the Fed's tightening of monetary policy to fight inflation will affect markets, make sure to check out our video we did on that topic back at the end of January. I'll put a link to it in the description down below. On this channel, we'll keep a watchful eye on inflation, the housing market, and trends in the overall economy. So make sure you're subscribed and hit that notification bell if you want to know right away when our next video on those topics come out. We'll also be providing updates on the war in Ukraine and how it is affecting the U.S. economy, so be on the lookout for those as well. And if this video is useful for you, please give it a thumbs up and share it with others to support the channel and help us grow. Thanks for stopping by, and I'll see you in the next video.